In the interest of time and having everything done on schedule, we'll go ahead and get started. We're definitely very excited today to have Melissa Brown here from Axioma, and she's going to present on the current state of market risk, and so it should be an interesting presentation. If you're not familiar with Axioma or Ms. Brown, she's Senior Director of Applied Research at Axioma. She also spent 10 years at Goldman Sachs Asset Management, mostly in the applied quantitative investment strategies group. And so anyway, great speaker. Anxious to have her start, and I'll go ahead and turn it over to her.
Thanks. Oh, I need to. Okay, I'll just wait till we get presentation up here. But thank you everybody for joining. I don't know how competitive you all tend to be with other cities in Texas, but I've got to say the turnout here is much better than it was in the other cities that I gave this presentation in. So thanks very much. So what I'm going to talk about today is the current state of risk in the market. For those of you who are unfamiliar with Axioma, we are in the business of providing portfolio construction and risk management solutions to asset managers and asset owners. So we basically provide or house data on market risk across 20,000 securities and which then get built up to portfolios and markets. And so my job is basically to take this vast amount of data we have that is largely focused on volatility in markets and to kind of wrestle it into a usable format, into a way that we can help investors get a better handle of the risk environment in which they're investing. So, what has had a big impact on markets over the last 6 months or so is the Fed taper. So we're going to talk about the impact of the taper, but we're going to talk about a number of other things as well. So let me make sure. So we'll talk about the current state of market risk. I'm just going to give a very quick overview of how we're looking at risk. We're going to look at how risk may compare across different countries and different regions. Look at some of the drivers of risk. Why is risk changing? Or why is volatility changing? One of the things that I'm going to spend, or the thing that I'm going to spend the most time on is a concept we've been noticing for the last few months, which is basically how emerging markets have become increasingly differentiated from developed markets in terms of their risk-return trade-off. But they've also become more and more differentiated from each other. And then, assuming we have time, I'm going to talk a little bit about a few other topics. So let me just make sure we have enough time. So what we saw at the end of the second quarter was a sudden and sharp increase in market volatility that was driven basically by the Fed's, well, at least we assume it was driven by the Fed's announcement of potentially tapering, of slowing down on quantitative easing. At the same time, we were also looking at a few other issues. One was increasing concern about a slowdown in China. And a third thing that was unique to Japan, but there was starting to be a lot of concern about the potential impact of Japanese economic policies. So, by the end of the second quarter, we had this kind of perfect storm that, and I'm going to show that the impact of it in a minute, but kind of affected Japan, emerging markets, China, but other markets around the world. So we had this sudden and sharp increase in volatility that we believe was driven by concerns about the impact of the taper. But as time went on, it seemed that investors were starting to be a little less concerned about the impact of the taper, or at least looking at the trade-off. If the Fed is positive enough on the economy to start to taper, well, that's actually good news, because it means the economy is doing better than expected. And so we've actually seen volatility come way down and hit almost historically low levels since that spike in the second quarter. Japan was impacted the most in the second quarter, but it's also come down quite a bit since then. Some of the drivers of risk, so it's not just overall volatility. The way we think about volatility is you start with the top line. So maybe, what is the volatility in the Russell 1000 index, or what is the volatility for the FTSE Developed Europe index? But then we want to kind of peel the onion down a little bit and look at what's driving that. Why is risk in Europe changing? Is it because currency risk is changing? Is it because country risk is changing? And so I'm going to talk about that a little bit. Again, currencies really got hit by the announcement of the taper, but have eased off a little bit. One of the things that was, I guess, a big issue that seemed to, every day if you opened the Wall Street Journal or another financial newspaper, they would talk about how high correlations were. So this goes back a couple of years. And so, basically what was happening there was, rather than companies being distinguished by their own individual characteristics, there seemed to be one common theme that was driving stock prices. So the benefits to being a good stock picker were much lower, because everything, in that kind of risk on, risk off environment, everything was either moving up or down at the same time. However, we've seen that correlation issue also really dissipate, and so we're looking at, again, very low correlations among stocks. Now, I think if you thought the impact of high correlations was bad, you might assume that, this is great news that correlations are low, but I'm going to talk a little bit about what some of the actual problems are with lower or the correlation isn't the whole story, is basically. I'm going to talk about that a little bit. And then, as I mentioned, I'm going to talk a little bit about emerging market risk and how risks in emerging markets have changed relative to developed and relative to each other. But kind of one of the bottom lines here is that risk or volatility. So when I say risk, I generally mean volatility here. Volatility is quite low. It's well below average. And I'm going to talk a little bit about why we think that actually we could be in this low volatility environment for a while. So I'm just going to veer off a minute here and just talk about a little bit about Axioma's business, because as I mentioned, we are in the business of providing risk models for investors. So what are we looking at here? Basically, we are attempting to come up with a prediction of volatility. So what do we think the volatility of a given market is going to be over two different horizons? So the kind of nearer horizon, what do we think is going to happen over the next couple of months? And then more of a medium horizon, or what do we think volatility is going to look like over the next 3 to 6 months? Most of our clients who use our models are more focused on a medium horizon. You don't want to be rebalancing your portfolio every time there's a little blip in short horizon risk. But short horizon risk can be very useful in helping us determine what's going to be happening over a longer time period. We also look at risk from a number of different vantage points. So many of you may be familiar with fundamental risk models. So there you're looking at a set of predefined factors, things like countries or currencies or sectors or style factors like size or liquidity or leverage, all things that are predefined, and they are what defines what's going to drive volatility. And so fundamental factor models are good in that you can kind of tie back what's happening in volatility to these factors. So you can say, wow, I've seen risk in the insurance sector, really skyrocket, and that's driving changes in risk in my portfolio. Or you might say, wow, we've seen a lot more volatility in small stocks than we have in large stocks. That may mean you want to move down the size of your portfolio or move up the size in your portfolio. But so you've got these predefined set of factors that are intuitive and very helpful. But sometimes these models can miss something. For example, in 2008, we're looking at a global financial crisis. We're looking at a crisis driven by issues in the mortgage market, and that's not a factor it wasn't a factor in our fundamental model. As far as I know, it wasn't a factor in anybody's fundamental model. And therefore, there's something that's really driving market volatility that's not being picked up in the fundamental model. So we also look at a statistical variant of model, which essentially lets the data speak. And I'm not going to go into too much detail. And probably with all the things I have to say, it's probably not worth going into too much depth on the statistical models. But basically, the idea there is if there's something bubbling under the surface that is causing increased volatility, it's more likely to be picked up by the statistical models than the fundamental models. We look at volatility at risk for 14 different countries or regions or globally. So we're basically covering the whole world, developed and emerging markets. So let me now go, and I hope you can kind of see this. It's probably a little hard to read what's on the x-axis here, but so this is predicted risk, so what we expect volatility to be over the short horizon, so over the next couple of months, by various benchmarks going across the bottom here. So we start on the left-hand side with the Russell 1000, we're ending on the right-hand side with the FTSE All-World Index, and then we're looking at 4 different time periods. So the green bars are what we expected volatility to be at the end of last year. The red bar is what volatility looked like at the end of the second quarter. The purple bar is what volatility looked like at the end of the third quarter. And then the blue bar is a risk forecast as of last Friday, so much more recent numbers. So you can see, hopefully my voice is loud enough here. This is Japan. So we had this huge spike in volatility in Japan, as I mentioned, in the second quarter, but then a huge drop. I mean, what does that mean? Well, if you're investing in Japanese stocks, you're probably doing a lot of trading around that, to bring down the risk in your portfolio that went up, and then all of a sudden you are trading again to get more risk in your portfolio. Most of the other regions were not that dramatic, but I would point out a few things. One is, these are all different European benchmarks. If we looked at this chart a year ago, the risk in Europe was dramatically higher than it was in Asia or in the US. There was still that kind of lingering concern about the European debt crisis. But that risk really seems to have dissipated And we're seeing even the so-called Euro crisis countries, or some people call them the peripheral or Southern European countries, risk has come way down. It no longer really stands out dramatically. So what we've basically seen throughout this year is volatility shifted from west to east. So this chart was kind of in the opposite direction a year ago. Another observation I would make here is that in the US, unlike any of the other regions that we're looking at, we've actually seen volatility increase. I can't stand and point at that thing anymore. Getting blinded by the light there. Typically, we see changes in volatility in the US, and that kind of filters through to the rest of the world. But what we're seeing right now is actually very different. We're seeing recently, at least at the beginning of October, on the heels of the government shutdown, the US kind of stood alone with volatility increasing and volatility continuing to go down in the rest of the world. So that's the kind of point of what we're seeing for our short horizon, or 1 to 2 month kind of forecast.
Can I ask you a question?
Yes, you can.
How do you define volatility for your model?
That's a good question. So basically, the view of our models is that volatility will tend to persist. So what you've seen recently in volatility is likely to continue. We look at, for this particular model, we're looking at 2 years of data and exponentially weighting that data so that yesterday has more weight than the day before and the day before that, but we're still looking at what volatility, how prices were moving 2 years ago. We're using a fundamental factor model. So basically, as I mentioned before, kind of peeling the onion, we're looking at how do countries look on this breakdown? How do currencies look on this breakdown? How do various industries look on this breakdown? How do various style factors look on this breakdown? And then, most importantly, how does the market look on this breakdown? And so you've got all these different components of risk, which then get rolled up into a forecast. I know that's probably not a very helpful description, but hopefully it will become a little bit more clear as I go through some of the charts and we can kind of see some of the underlying components. So here we're just looking at the same thing from the perspective of our medium horizon models. So I'm just going to try to. So what we're looking at here is now the progression of this volatility forecast for various benchmarks. So on the left-hand side, we have the Russell 1000, Russell 2000, and Europe. On the right-hand side, we have Asia ex-Japan, Japan, China, and Australia. So basically, we're saying, so right here is where the tapering was announced. So in Asia, you got a big jump in volatility, less so in Australia. You got a big jump in China. Japan had its own set of issues. Their volatility was already increasing. Looking at the US, we actually had a sharp increase in April as well, but also a big, Europe in particular, but also the US, a big increase. And then it's basically drifted back down since then, except for right here, right at the point of the government shutdown. Again, we're looking at volatility go up. So in terms of our model, what does that mean? Well, it wasn't, what we were not seeing there was that any particular industry was looking better or worse in terms of its volatility, or any particular style factor. That was really driven largely by changes in overall market volatility, that jump up. But again, seeing that jump there, that you haven't seen in other markets. And then when we look at broader benchmarks, the green line here is the FTSE Global Developed Index, so developed markets, and then the blue line is emerging markets. So again, a much bigger impact on emerging markets than on developed markets in terms of when the Fed announced the taper. But even emerging markets have settled down a bit since then, although emerging market risk remains well above. Actually, what's to me most interesting about this chart is not so much that emerging market risk is higher than developed market risk, but that for long stretches of time earlier this year, there was no difference. So we're looking at volatility in emerging markets be roughly the same as volatility in developed markets, which is a little bit counterintuitive. You would just expect emerging markets to be riskier, but until something, some exogenous force came to change things, it didn't really matter if you were investing in terms of your risk-return trade-off. It didn't really matter if you were investing in emerging or developed markets, and that's pretty unusual. And then this is just a longer-term perspective on these numbers. So we've got the red and blue lines are the risk forecasts, and the orange line is the direction of the market. On the left-hand side, we've got the Russell 1000 going back to 1988, which is as far back as we have index data. And on the right-hand side, we've got the Russell Developed Index going back to 99, which is, again, as far back as we have index data. The point here is that we have had long stretches of time where we've had very low volatility. That's been associated with strong markets. We're not quite down to that historical low level, but we're pretty close. So risk is low. One of the things that people say to me the most is, well, doesn't that just mean that we're going to see volatility climb? Doesn't it mean that volatility has to, by definition, increase? And my point of view is that volatility can actually stay low for a long period of time. That tends to be good for markets. It's good for markets. It is perhaps not as good for active investors, which I will get to in a little while. But I don't think that just because volatility is low that we think that volatility has to go up. It can stay low for a long period of time. Of course, in the past, when that's ended, it's ended badly. So you've got a very sharp and sudden increase in risk. But right now, we don't see the underlying elements of that potentially sharp increase in risk. So I talked a little bit, again, about the underlying components of risk. So what are we looking at here? So for developed markets on the left, we're looking at currency and country risk. And so you can, and again, this is just since the end of the second quarter. So you can see, for example, here, not a dramatic, but some increase in country risk most recently, but not, you had actually seen some increase in the second quarter. Emerging markets, again, a little bit of an increase in both country and currency risk. So a couple of takeaways from these charts. One is that currency risk is higher than country risk. So more of the volatility in your portfolio is likely to be driven by currency risk. And so again, important to kind of track what's happening in the currencies, which is why on the bottom here, we're looking at individual currencies. So where is that risk changing? So again, as we peel the onion down to its layers, what's driving those changes in currency risk? So the blue bars are what happened in the second quarter, which I apologize, I'm not showing in the top chart there. So we had seen an increase in currency risk in the second quarter, and you can see it was the yen drove that. The yen is the highest bar there, but also the Aussie dollar, and then the New Zealand dollar, probably related to the Aussie dollar, and some of the Scandinavian currencies. That largely reversed in the third quarter, so that's the red bars, although it did not for the Norwegian krona, and I'm not sure I can explain why that is. But then in October also, currency volatility has continued to fall. So we can see that in the green bars. So on the left-hand side, we have the developed currencies. On the right-hand side, we have the emerging market currencies. And I apologize, I should have made this bigger so you could see what the currencies are. But we're seeing a much more mixed picture when we look at the emerging markets. So in the second quarter, most emerging market currencies saw increases in volatility, but not all of them. In the third quarter, a few, particularly the rupee, the rupiah, and the Turkish lira, saw very large increases in the third quarter, whereas other currencies, the ruble, for example, saw decreases. And again, we're seeing those same mixed results throughout October. So, I'm going to keep coming back to this idea of the emerging markets separating or diverging in terms of their potential risk-return trade-off from developed markets and from each other. And this is kind of the first place we see this. So you're seeing just bigger differences in emerging market volatility. Again, as an emerging market investor, I think you need to have a firmer handle on your return forecasts as these risks change. So that's currencies. Here now we're looking at countries, and I'm not going to go through each of these individual countries, but the picture is pretty much the same. That particularly in the emerging markets, we're seeing much bigger swings in volatility and much bigger differences across the different countries that make up the emerging markets index. Most of us look at VIX, or here I also show the V stock, so the European equivalent of the VIX index. And the same way, a few slides ago, we were showing this increasing decreasing of risk, the continuation of risk decreasing. We're seeing the same thing in the VIX index. The VIX is well below average and kind of nearing lows since at least 2007. So the VIX is a completely different way of looking at market risk, but it does tend to correlate with our risk forecasts. You may ask, why don't I just use VIX if I want to get a handle on market risk? Well, VIX gives you kind of the top line, but it doesn't give you all of the underlying components. It doesn't tell you whether currency or country risk is changing, or which currency, or which industries are seeing bigger and smaller decreases. VIX is very useful from a top line, but you can't really use it to manage active risk in a portfolio. So that's why people use risk models and not just this VIX index. So again, talking about this idea of market differentiation. And we've got a little more focus here on emerging markets versus European markets. But on the left-hand side, again, the chart of risk for FTSE emerging versus risk for developed Europe in this case, which is the green line on the left. And on the right-hand side, we're showing the difference between the two. So once again, we had a period of time here where emerging markets had the same level of volatility as European markets, but that has changed dramatically over the last few months. I'm sorry, I forgot to include, there's another chart that goes with this that shows this chart over a longer period of time. And what it shows, what it says is that this is actually a really big increase in differential. That, relative to what we've seen over the past 5 years, we're seeing emerging risk really break away from risk in Europe. Part of the reason we're using Europe here as the basis of comparison in the next in some of these charts is because a couple of years ago you were seeing it wasn't really driven by the same things, but you were seeing a crisis in Europe, a debt-fueled, concerns about debt. You were seeing in Europe, and that's settled down, but now we're seeing more issues in emerging markets. So this is a chart that shows, let me explain what we've got here. So we've got the bubbles. The blue bubbles are developed markets. The orange bubbles are emerging markets. The size of the bubble is the relative size of the market. So back in February, basically, and I'm sorry, along the x-axis is volatility. In this case, this is realized volatility. So this is the standard deviation of daily returns for each of these countries over the 6 months ended February 22nd. The y-axis is the return of that market over that same 6-month period. So basically, we're just looking at kind of a risk-return trade-off here. And you can see here that the emerging markets are pretty much on top of the developed markets. There are some differences, but you are getting a very similar risk-return trade-off in emerging markets as compared with developed markets 9 months ago. And you weren't seeing a lot of differentiation among the emerging markets either. So, it's similar if you were looking at, India or Indonesia or China. You have Greece way out here. So Greece had done quite well by that point, but was extraordinarily volatile. And that really stands out compared to what you're seeing in the rest of the world. You can also see some of the Euro periphery countries here. So Italy, Spain, Ireland, more volatile than other countries. But basically, everything was clustered. So then we roll ahead to the end of June of this year. And you can see how the emerging markets have started to separate from the developed markets. So at that point, you're looking at a risk-return trade-off that's generally been much better for developed markets, and most developed markets versus most emerging markets. So emerging markets were separating from developed markets, but we're still not dramatically different from each other. And we have Greece out here. So Greece kind of messes up the whole chart by being so volatile. But so Greece's return had come way down. But so again, this separation of emerging versus developed. If we now move ahead to a recent date, so a week ago, you're still seeing the risk-return trade-off for emerging markets look substantially worse than the risk-return trade-off for developed markets. So really, you want to be up there in the northwest corner, low risk, high return. Emerging markets have moved far away from that. But in addition, they've moved far away from each other. So you've got, India, Indonesia out here, but, China or Malaysia or South Africa, they don't look so different. So again, the asset allocation or the country allocation decision within emerging markets has become increasingly important. So this is all based on equity market data. We also see something very similar in currencies. So here we're just looking at, on the left-hand side, emerging currencies, and on the right-hand side, developed currencies. This is all relative to the US dollar. So in April and May, for example, currencies weren't doing much. But then all of a sudden, as concerns about China and concerns about the taper started to come out, you started to see a big differentiation in currency performance. So the real and the rupee were way down, whereas other currencies weren't down so much relative to the dollar. We also see, by the way, a little bit of differentiation in developed markets where we see the Aussie dollar, which was, I think at the time, very much impacted by what's going on in China. The Aussie dollar also kind of broke away from the rest of the pack. But most importantly, again, emerging currencies were looking very different from each other. If we look at bond yields, at sovereign bond yields here, we're seeing something similar. So there, in the emerging markets on the left, you have very different levels of yield. South Africa and China are kind of on the low end there, and Brazil is on the high end there. But again, by the end of June, yields had gone way up for Brazil, for India, and Indonesia, and hadn't really done very much for the other emerging countries we have on that chart. You also, with the exception of Portugal in Europe, also saw very little impact on sovereign yields for European markets, even though you see the continued differentiation of the lowest yielding core European countries like Germany versus the periphery countries like Spain and Italy. And then we have Greece, of course, which again stands out from everything else. And Portugal here stands out as well. Again, the same picture from the point of view of looking at CDS spreads. So CDS in India way up from June through August. Also similarly Indonesia, but not so much in other countries. And again, way up in Portugal, but not much change. In the countries that, as I mentioned, 2 years ago were the countries really in trouble. Spain and Italy, things seem to have settled down there. So not so much concern reflected in the CDS market either. And then one more thing I would just point out is in this continued differentiation of emerging and developed markets, we've seen recently volume increase. So this is basically trading volume in these markets. Big increase in volume in the global developed market, big decrease in volume in emerging markets. I think investors looking at this risk-return trade-off doesn't seem to be there so much in emerging markets. I don't know if they're getting out of emerging to buy developed, but again, there is not a huge amount of activity as I think investors have become more and more wary about this risk-return trade-off in emerging markets. So again, that kind of ends the whole section on this differentiation of markets. I'm going to move on just to talk a little bit. Let me talk about one thing here. So what we're looking at here is the difference in the predicted volatility that comes out of our statistical models, which I mentioned just let the data speak and don't have predefined factors, versus the fundamental models, which do have a series of predefined factors. So what we look at here is whether there is something in the statistical models that suggests there's some risk bubbling under the surface. It's not necessarily a risk that is there all the time. It could be something like a mortgage crisis, or it could be something like a European debt crisis. Of course, in the beginning of the mortgage crisis, we didn't know that that was what it was, but in retrospect, we can kind of say what it was. So what we're looking at here is the expected volatility from the statistical model substantially higher than what we're seeing from the fundamental model? In other words, is it seeing something bubbling under the surface? And the good news is that in general, we don't see that. We see, so if we're looking at the 3 to 6 month forecast on the top two charts. On the left-hand side is US and Canada and Europe. And with the exception of the Russell 2000, where the statistical forecast is slightly higher, in general, the statistical forecast has been below the fundamental forecast. Same thing if we look more broadly at emerging or developed markets. So from the perspective, from our 3 to 6 month horizon perspective, and generally also on the bottom here, we're looking at our 1 to 2 month horizon. Again, we're not, although we're seeing in the Russell 2000 and the TSX Composite, the Canadian market, the statistical forecasts are slightly above the fundamental forecasts. Those differences are actually quite small. And so we view this as being very good news, that there doesn't seem to be some risk that fundamental models are not identifying, which is one of the reasons we think that we can continue to stay in this low-risk environment for a while. So when we talk about volatility, and this is another way to get at your question about what drives our forecasts, the two major components of risk forecasts from a factor model are factor volatility and factor correlations. So if things are becoming more correlated, if all of a sudden size and value are moving together, or if Italy and Spain are moving together much more so than they used to, it's harder to be diversified in that kind of environment. You're going to have higher risk because of that. And so one of the things we want to look at is what is driving this change in risk. So let me just, oops, I'm going the wrong way, sorry. So basically, if we take, for example, the Russell 1000 index, which is the blue bar all the way on the left, what could be changing the risk there? Well, it could be the stocks in the Russell 1000, but of course, they don't change very much. So that's not going to really drive a change in risk. It could be the relative riskiness of the stocks in the index. So are the stocks themselves becoming more highly exposed to risk factors? Again, that doesn't generally drive a change in benchmark risk. What we're really looking at are the set of bars on the right here. Are these individual risk factors becoming more volatile? So are industries becoming more volatile? Is the differential between large and small cap stocks becoming bigger? So the size factor is becoming more volatile. All that kind of stuff. That's under this set of bars here. And then here we're just looking at are factors becoming more or less correlated. So what we're looking at in the third quarter here is that in general, it's just that all of these factors have become less volatile. What's perhaps more interesting, at least to me, on the bottom, is when we look at this on a stock-by-stock basis. So rather than saying we're looking at a factor model, here we're looking at a stock-by-stock breakdown of risk. So basically the two things are stocks themselves becoming more volatile, and are they becoming more or less correlated with each other? So I mentioned before this impact of correlations. When we look at it, look at the results in the third quarter, we can see that in general, stock volatility had gone down. So again, this is a contribution to overall risk. But correlation, this decrease in correlations, was also important to driving this change in risk. And we see that as well when we look at a more recent period in October, that in some cases, correlations, for example, in Asia, have gone down so much that that's really what's the biggest driver of risk coming down. So it's not so much that volatility is coming down, it's that correlation has come down. And so I just want to show some charts here that show that picture. So what we're looking at here is the median. So we're taking every pair of stocks in the benchmark, so let's say the Russell 1000. We're calculating the correlation of returns over the past 60 days, and then looking at the median of that across the whole index. So the median 60-day asset correlation, if you see here we've got a much longer history. So 2008 correlations really spiked up. They came back down, but then they spiked up even more. Came back down, spiked up even more at the beginning of 2012. But what's been kind of interesting is that those peaks, where those spikes were, the peaks have become lower and lower over the past couple of years. And we've seen that in the US, in Asia, in FTSE developed and FTSE emerging. Generally correlations have been trending down. The only place we haven't seen that is in Japan, where, and China to some extent as well. We're not seeing such a big impact of lower correlations. So if you believe the premise that high correlations made it much harder to outperform the market because there was kind of less benefit to being a good stock picker because everything was moving together, then the flip side of that should be that lower correlations are good and do drive more benefit to being an active manager, to being a good active manager. Of course, if you're really bad at picking stocks, it doesn't help you. But that's only half the story. So I'm sorry to be the bearer of the bad news. It's not just correlation that matters. The other thing that we look at is dispersion. So if I take, let's say, the Russell 1000, and I take it's January, and I take the returns in January for all of the stocks in the Russell 1000, and then calculate the standard deviation of that. So basically, what's the spread between the best and worst performing stocks? That's how I kind of think about that. That's what we call dispersion. And that, I think, is a much better indicator of the potential value added from good active management. So the bigger the spread between the best and worst performing stocks, the better, the more reward there is to being a good stock picker. That spread, that dispersion, is related to correlation. So if correlations are high, dispersion, so everything's moving together, dispersion is going to be low. But dispersion is also a function of the overall volatility in the market. And as we've seen, volatility is very low. And so what these charts are showing is the red bars is the average dispersion, so for the year-to-date period, and the blue bars are the long-term average. So you can see that in every market except for Japan, the recent period, the dispersion has been much lower, meaning it's been much harder to basically add value from being an active manager. I see people are leaving, and I don't want to keep anybody here longer than I have to. So the one other thing I'm just going to talk about briefly is, one of the big trends that we've seen in the market is the trend towards low volatility investing. So investors seem to be flocking to these low volatility strategies. And the way we try to proxy that and the performance of that by looking at one of our risk factors in particular, which is volatility. So basically the way this volatility factor is defined is that the highest, stocks that have been the most volatile have the highest ranking on volatility, and the least volatile stocks have the lowest ranking. That kind of makes sense, right? So if the line is trending down, it means that lower volatility stocks are doing better. So what we've seen here is that we've, again, a lot of differentiation between markets. Low volatility is not necessarily a strategy that is best followed globally. So for example, you can see the dark blue line is Asia. So low volatility until about June worked very well in Asia, better than in any of these other markets if we're looking at a kind of a 12-month basis. But it really doesn't do much at all in China. In Europe, it had been doing well, but was a particularly bad strategy for the last few months. When we look on the right-hand side at the broader benchmarks, it seems to have been a much better strategy to be used in emerging markets relative to developed markets. So, I don't know if this is going to be the beginning of the end of low volatility investing. I would kind of sense that if the overall market volatility is so low anyway, perhaps investors are less likely to seek lower volatility in a low volatility portfolio. Maybe that's what we're seeing here with this flattening out of performance. But it is, just something that we watch. Now, just the one last thing I'm going to talk about. For those of you who are interested in any of this data, on our website, so www.axioma.com, we actually provide daily risk reports for all of these regions. So a lot of the charts that have been in this presentation, you can see there's no firewall. You can just go straight to our website. If you look at the bottom left-hand corner of the front page, it says Daily Risk Monitors, and you just click on that and get many of these different charts. And the data is updated daily. Of course, nobody looks at it daily, but on the day that you do look at it, you'll know that you have the most updated data. So I'll just point you there if you find this data on volatility interesting. And then just to summarize, we see it seems like the concerns about the Fed's tapering have abated. The impact of the U.S. government shutdown has affected the U.S. To some extent, but I guess not surprisingly, hasn't really affected other markets. Volatility has been the major driver of declining risk, but correlation has also been a big contributor. We're seeing this differentiation of emerging markets relative to developed markets, and that seems to be continuing. The fact that particularly our statistical forecasts have fallen below our fundamental forecasts suggests to us that there's not a big risk surprise out there, at least in the near term. Therefore risk, the low risk environment that we're seeing ourselves in, which is well below average, we think at least can continue for a little while, which should be good for the stock market. That's it. I'm just a minute over. So.
Actually, we have time. If anyone has questions, or maybe one or two questions, anything.
Yeah.
Yeah. So I'm going to kind of hit this question a little bit differently, maybe. So if I am looking at your product that is the risk forecast, I think qualitatively I get it. But let's say I've got a currency model that needs a standard deviation input. Is that one thing that you provide when you're talking about your 3 to 6 month forecast? I've got an intermediate term model. Is that an output, or is that the output? That's the mathematics of how this would input into a model that I would have is where I'm a little lost.
Well, I mean, where most people kind of use these forecasts is in portfolio construction. So you have a forecast. It may be of currency returns. It may be of an individual stock return. It may be, on a country basis. And but you can't, risk and return are two sides of the same coin, so you can't just think in risk space. In return space, you want to know what risk that entails. So the users of our products will use these forecasts to try to assess that risk-return trade-off. How much volatility am I going to get for a given set of returns? Many of our clients actually use an optimizer that, very mathematically determines that risk-return trade-off, but we also have a lot of clients who use our models just more for a risk assessment. So, wow, I think, Greece is now a great investment, but, how is that going to trade off with risk? And so that's generally, how it's either in optimization or just more in risk assessment, how people use our stuff. If you want more of the, mathematics behind it, we can, there's plenty of stuff we can provide you on that.
If I would have looked at Europe a year ago with high risk and I was a low risk return investor, I would have shorted the euro and lengthened emerging markets, which turns out to be, it might have lowered my volatility, but it reduced my returns by quite a bit more. How do you, and your argument is that this risk is stable, or relatively, or this volatility is stable. I have not seen that in my lifetime. When you have, let's say the Fed does decide to taper, if they ever do, if they ever do it, that'll be a shock to the market. You don't have a continuous time period. You don't have a continuous time series. There's different meanings on each of these time series, and they're short.
And I probably did overstate the persistence of risk. What I really should have said is the best forecast of risk today is yesterday's risk. Now, yes, of course, things happen, and whether it's, a Fed tapering or, all of a sudden potentially Greece is going to default on its debt or pull out of the euro or, any of those things. Yeah, and yes, those things do come up, and I talked about having all the stuff available daily. One of the reasons we use daily data is so that we can react to that stuff very quickly. We are, when you say if you might have sold the euro just based on its risk characteristics, but chances are you would have sold the euro because you thought it was going to do really poorly relative to the dollar. And all we're trying to do is come in and say, okay, but how risky is that? How much volatility can you expect from that bet? We're not trying to forecast returns in any of these factors.
Do you look at any of the correlations between expected economic growth between countries and then overlay that with things like commodity volatility as well as currency and interest rate policies?
That's not part of the model right now. We don't have an economic growth component, but just in the last week or two, we've released a macroeconomic model that does take more of that. We're still not forecasting the growth for countries, but we are looking at recent growth and how that correlates with the volatility of that market. Right now, the macro model is just for the U.S., so we don't actually have countries in there, but we would have other economic indicators or oil prices or other macro factors that are going to affect volatility. Next time, in a year or so, maybe I'll be back here and to be talking about our global macro model. Yes.
Yeah, when you look at the VIX, you talked about there's some underlying factors. Of those underlying factors, are there any that consistently lead the VIX and consistently lag the VIX?
don't know. I mean, the VIX tends to be very immediate, so that, you know, on that day you get the Fed announcing a taper, you know, you're going to see immediately the VIX jump. I don't, but, you know, 3 days later, it may be something else that's a driver of the change in the VIX. So while we do see a correlation between our models and the VIX, I don't know that there's any particular factors that would lead or lag the VIX. More likely lag the VIX, because the VIX is such an immediate reaction to what's happening.
Why don't we wrap it up with that? Definitely, thank you very much.
Thank you. Thank you. Oh, thank you.
Sure.
That's so nice. Thank you very much.
And awesome. And thanks for everyone for coming. The next one is December 11th at Paisanos. It's Brian Singer. Should be a good presentation as well. So great. Thank you.